Today we'll be presenting accounting. Your presenter is Mr. Bengu KJ from Vulamasango. We'll be dealing with fixed asset. Right. Now let us first start with the questions that might be asked. Right. Now the possible questions that we might find in an exam, we are going to have a carrying value at the beginning of the year, and then now we are going to have a cost price at the end. We are going to have disposals at carrying value, depreciation, profit or loss on sale of an asset, and the carrying value at the end of the year. Now, on this presentation, we are going to try to explain everything that might be possible on the questions, on the exam. The first question, we are going to talk about the carrying value. Now, the carrying value, when we are talking about the carrying value, we're actually saying how much is the asset actually having at this point? How much has it left with? In actual sense, I'm trying to say, if we buy an asset, we are going to spend a certain amount, right? We are going to spend a certain amount. That certain amount, we are going to call it a cost price. That's how much we've paid for an asset, right? Now that cost asset will lose value over the year. If it loses value over the year, now we are going to subtract what we call accumulated depreciation. That accumulated depreciation means accumulated depreciation means the combination of depreciations over the years. Now we are going to have what we call the carrying value at the beginning. Now we are going to get the carrying value at the beginning by saying cost price minus accumulated. That will be the first question that we're going to have in an exam, right? Now the second question, we are going to have a cost price at the end. The cost price at the end, it actually says, now we have started a year. Let me just try out something and say this is our financial period. We are starting a year in January. We are ending it in December. Now we were having certain vehicles or equipment or land and building at the beginning of the year, right? Now at the end of the year, what are we having? Now what I'm trying to say is, what cost are we having from the beginning to the end? Now how are we going to get that? How are we going to get that? Now, let me just show you how we're going to get the cost price at the end. Now, the cost price at the end, we are actually going to say cost price at the beginning, we add up additions, we subtract the disposals at a cost price, that will give us the cost price at the end. Now, let me assume that we had two vehicles at the beginning of the year. Those two vehicles were worth about 50,000. Let me just write 80,000. These are our vehicles at the beginning of the year. Now, we went on sometime in June. We decided to buy another vehicle worth about 10,000, right? Now, how much are we having now? We are having 80 plus 90. That is the cost price of the vehicles. Now, then we decide in July that we are going to dispose then a vehicle. We are selling off a vehicle. Once we sell off a vehicle, we call that a disposal. But now we want the cost price of the disposed vehicle. How much is it? Let me assume we are selling a vehicle from the 80,000. That is worth 20,000. That will give us what is happening at the end. Now we're going to say 80,000 plus 10,000 minus 20. It will give us what we have at the end. That will be the cost price at the end. Right. I can erase my time frame. And then move. Let us move and check the next question. The third question that you might have in an exam, it is the disposals at carrying value. The disposals at carrying value, we want the carrying value of the disposed asset. How much now? I'm no longer talking about the cost price now. I'm saying the carrying value of the asset that is being sold. How much is the carrying value? Remember, I set the carrying value, it's cost price minus accumulated depreciation. Now we want the carrying value of that asset that has been sold. How are we going to get that carrying value? We are going to have a cost price of the sold vehicle. I want the sold vehicle, the cost price of the sold vehicle, and then we subtract the accumulated depreciation of the sold vehicle at the beginning of the year, and then now we subtract the depreciation for the current year. Depreciation for sold for the current year. That will give us the carrying value of the sold asset. Right. Now, it happens sometimes that we are not given out the cost price. We have to identify the cost price ourselves. Now we are going to say, for us to find the cost price ourselves, we are going to say cost price at the end plus the disposals at the cost price, the original price, minus cost price at the beginning. That will give us the cost price of the cost price of the sold. If that does not happen, we are not given the cost price at the beginning and the cost price of the sold. Now there is a possibility that we might not have this. We might not have cost price at the beginning and the accumulated of the sold at the beginning. Now, what are we going to have? We are going to have a carrying value at the beginning for what is called the sold ones. We are going to have the carrying value of the sold vehicle. And then we are going to subtract what? The carrying value at the beginning of the sold vehicle. We are going to subtract the depreciation for the current year. That will give us the carrying value at the carrying value of the that will give us the carrying value of the sold. That will actually give us the carrying value of the sold. That is what we are looking for, the disposal asset at carrying value. Sometimes we may use this format to we can use an asset disposal. I predict most of you are more used to preparing an asset disposal. Now, we can also prepare an asset disposal to find this. But in paper one, there is the most cases that we are going to get the carrying value. So it's not possible to use the asset disposal because we're going to be given the carrying value, and the carrying value using the asset disposal. Let me try and draw out the asset disposal before I can explain. Now, the asset disposal increases on the debit side, it decreases on the asset on the credit side. So we want to identify the asset that is being sold. We either sell off a vehicle or we sell in an equipment. Those are two things. Those are two assets that we can sell. And then now those assets that we are selling, they can do what? They can lose value. That is accumulated depreciation. Now, we want the accumulated depreciation at the beginning, and then we add the depreciation for the current year. Now we are saying this is the disposals at carrying value. Right, this is the disposals at carrying value if we are using an asset disposal. We are saying cost price of the sold vehicle or equipment, we subtract what accumulated at the end. Now, what I was saying is, if we are given the carrying value of the sold, it means we are already given something here and something here. Now, it's not possible to say cost price at the beginning minus accumulated depreciation. We cannot have this accumulated depreciation because this are already been given. They already said cost price minus accumulated. So what do we need there? We only need the depreciation. So hence I'm saying we need to subtract depreciation for the current year to get the carrying value of the sold. Right, then we can move to another question where we are talking about the depreciation. Remember, the depreciation is a loss of value. It's a loss of value on either equipment or vehicle. Land and building does not lose value. We only depreciate what? We only depreciate equipment. We only depreciate equipment and vehicle. Now, how are we going to calculate the depreciation? We have two methods of calculating depreciation. The first method, we have the straight one method, that is the cost price method, which is sometimes being called straight line. Now, in terms of the cost price method, we actually have to always be being considerate or look out for an equipment that is new. Always look out for new, sold, and unsold. In actual sense, unsold means the remaining ones are old. Right, how are we going to find the depreciation for new? When we are using the cost price method, we are going to say we take the cost price, we multiply rate, the rate is the percentage that is given, we multiply by the time frame. The time frame we know is over 12. But when we are talking about the new vehicle, we are saying, where do we count our time? Our time we count from the day of purchase to the end of the year. So we count going outside on the time frame, right? And then now for sold, we're also going to say cost price. Here we said cost price of new. Here we're going to say cost price of the sold. We multiply by rate. We multiply by time. It's over 12. But here, because now we are calculating the sold one, it means at the end of the year, we're no longer having that vehicle. So now we are going to count going inside from the day of the sold coming back to the beginning of the year, right? And then now we are going to have the unsold or remaining. When we are talking about the unsold or remaining, we're going to use a formula called cost price of old, that is at the beginning of the year, we subtract the cost price of the sold. Remember, at the end of the year, we're no longer having the sold one, because what happened? We have sold it. It's no longer there. Then we must take it out from the ones that you actually had at the beginning of the year. And then we are going to multiply by rate, and then we multiply by time. Remember, these ones are remaining. It means they have lasted the entire year. Then you're going to have 12 over 12. That is a calculation of using the cost price method. And be careful when we are talking about the unsold. Be careful of the fully depreciated asset. There is a possibility of a fully depreciated asset. What do I mean about a fully depreciated asset? If it happens that on the remaining asset we did not have, there was no sold. It means we did not sell any equipment, we did not sell any vehicle. There was nothing like that. Then what is going to happen in that scenario? We are saying there is a possibility of a fully depreciated asset. What do I mean about a fully depreciated asset? I'm actually saying an asset that has reached its lifespan. Now, in that scenario, how are we going to see that an asset has reached its lifespan? We are going to see, if we realize that the carrying value, we subtract the accumulated depreciation at the beginning, plus the depreciation for the current year, for the sold, it gives us a negative figure. Now, be careful. That is called a fully depreciated asset. But if it happens that, if we say there is another possibility where we can say that accumulated depreciation, it is greater than the carrying value, then we have what now? We have a fully depreciated asset. Right. In this case, I was saying the accumulated depreciation is greater than the carrying value. Here I was meant to say a cost price. If we have a cost price, we subtract accumulated at the beginning, then we subtract the depreciation for the current year. It gives us a negative figure. What does that mean? It means that asset is fully depreciated. Now, what do we do when an asset has reached its lifespan? Then we are going to say, therefore, carrying value minus 1. Now we are going to take the carrying value. And then we subtract 1. That will give us the depreciation. That will give us the depreciation for that equipment, of vehicle, for that current year, the old one. And then we move. Now let's talk about, we're going to talk about another method that is called diminishing balance method, or the carrying value method. Now, how do we write diminishing balance method or carrying value method? What are we saying? We are saying we are going to use a carrying value. And that carrying value must do what? The depreciation over the years must diminish. They must go down each and every year. They must diminish. How are we going to do that? We are saying we also have to be on the lookout for what? For new, sold, and unsold. Right now, how are we going to find the sold? The new ones. How are we going to find the new ones? Note this. The new ones are new. They have never lost any value anywhere. They have lost value somewhere, but onto us they are new. They have never lost any value. So what are we going to do? We are going to say we're still going to use the same one as cost price. Then we are going to say cost price of new multiply by rate, and then we multiply by time. And then for sold, we are going to say cost price of sold minus accumulated of sold at the beginning, and then we multiply by rate, we multiply by time. And remember, time when you're talking about new, we go outside. When we are talking about sold, we go inside. Right. And then we go to unsold. On unsold, we need to first find those that are remaining. In actual sense, we are going to say, let us first find the cost price of the remaining ones. So we are going to say cost price of old minus cost price of the cost price of sold. And then now we say minus now those ones we want the remaining. Then the old ones have lost value, including this one. Then we are having to say accumulated depreciation of old minus accumulated depreciation of sold, but which accumulated you are talking about at the beginning of the year. And then now we multiply by rate, we multiply by time. And remember, time is always 12 over 12. We were saying in this regard, an asset can actually be fully depreciated, right? Then it actually says it has reached its lifespan. Now you are going to calculate a depreciation for that current year. Let us assume the carrying value of that vehicle at the end of the year, it actually worth 50,000. That is the carrying value, right? Now, that carrying value, it is 50,000. Then it happens that it loses value this year. You have calculated depreciation for the current year. Now you just calculated depreciation for current year. The depreciation for current year gives you something like 70,000. The depreciation for the current year gives you something like 70,000. That's what you just calculated. But now, when you just look at this, you see that carrying value is 50, the depreciation is 70. Now, let us see this and say, okay, remember, we want to understand that vehicle before the end of the year, before we sell it, what value did it have, right? Now, in this case, we are saying the value means the carrying value. That's what we want to understand, right? Now we are saying in this case, okay, if we say carrying value minus depreciation, we want to understand what is the carrying value, right? Now in this case, we are going to say that will be carrying value at the beginning plus depreciation during will give us carrying value at the end, right? Now we are saying our carrying value, it is 50,000. Then we're going to have 50,000 minus 70,000. That will give us how much? Negative 20,000. Right. Now, what I'm trying to say is there is no way that we can have an asset with a negative figure. Right. Now, in our asset, we cannot allow it to reach its maximum to a point where that it is negative. We can never have an asset that has a negative figure. Hence, I'm saying we cannot allow it to reach this point. Hence, we are going to apply a method where we say carrying value minus 1. What am I trying to say carrying value minus 1? We allow it to lose a depreciation up to a certain point. Now, what's that certain point in this case? In this case, we are saying the carrying value, it is 50,000 minus 1. Now, let us allow that vehicle to lose up until 49,999. Now, the depreciation for the year will be 49,999. Why is that so? We allow it to lose up until at least so that if it loses up until 49,999, we'll have a carrying value of 1, not a negative. Now, let's see it. If we say 50,000 minus 49,999, then it means how much are we left with? We are left with 1. Then we have applied what we call a 1 rand rule. In that case, we are saying our asset cannot fully depreciate. Then we are going to have what we call a 1 rand rule. Right. Now, on this one, we're talking about depreciation. We said we are going to use a cost price method. Right. Now, this is our cost price method, right? We are saying for cost price method, we are going to find the cost price for new, right? That cost price for new, how are we going to get it? We are going to say cost price of new, we want the depreciation for new, sorry. We want depreciation for new. How are we going to find that depreciation for new? We are going to say cost price of new, we multiply by rate, and then we multiply by time, right? Now, we said again, we are going to find the depreciation for sold. Now, the new, when we are talking about the new, we said we are going to have over 12, but we are going to count going out. If we buy an equipment, let us assume our financial year ends in December. It starts in January. We buy equipment halfway through the year in June. If we buy an equipment in June, on the 1st, we are going to count going outside. We are going to count June, July, August, September, October, November, December. We are going to count going outside, right? That is for new. And then now we are saying the cost price now for salt, multiply by rate, multiply by time, right? Now we are saying the time frame is under 12. We are going to be given the rate, we are going to be given the cost price. Now, when we are counting for salt, we are going to count going inside. Right. Now, how are we going to find that? We are going to check our time frame. Remember, our time frame ends in December and start in January. Now, let us say we sell an equipment in August. If we sell an equipment in August, we are going to have January, February, March, April, May, June, July, and August, right? Now we sell it here in August, so we are going to count going inside. So what are we going to have? Going to have August 1, 2, 3, 4, 5, 6, 7, 8. Then that's how we're going to count when we have the sold. We're going to count going inside, right? And then now we are saying again, we are going to have the old ones. When we are talking about the old ones, how are we going to find the old ones? We are going to say cost price of old minus cost price of sold. Note, sometimes we don't have the sold asset, right? We don't have the sold asset, then it's zero there. There's no need to have the cost price of sold. Then we multiply by rate, we multiply by time. Our time here, because of these are old or these are remaining, it means they lasted us the entire year. So here we are going to find depreciation on 12 over 12, right? And then now I said there is a possibility. There is a possibility for this asset. There is a possibility for this asset if there is no sold. If there is no sold, there is a possibility of an asset that is there is a possibility of fully depreciated. Right? Now I can go to another slide, a clean slide, so that I can explain the fully depreciated asset. Now let us move along. Now we are going to explain here a fully depreciated asset. A fully depreciated asset. Remember, when I'm talking about a fully depreciated asset, we are saying an asset that has reached its useful life. It no longer has a useful life. It must be left. Then it must be left with what we call one rent. It must be left with one rent. That's how much it must be left with, right? It must be left with one rent. How are we going to see this? I said, if we are going to have a cost price minus cost price of that asset minus accumulated depreciation minus depreciation for the current year that we just calculated, we are going to have a negative figure. We are going to have a negative, let's say a negative figure. Then it means that asset, it is fully depreciated. Again, there is a possibility of having a carrying value, right? That is less. A carrying value that is less than the calculated depreciation. That is less than the calculated depreciation, right? Then it means in that case, we need to do what now? A carrying value that is less than the calculated depreciation. Then we need to do what? Apply 100 rule. Now, how are we going to see that? I was saying when I was explaining later stage, I'm saying, let us use an assumption. Let us assume that our carrying value for a vehicle is equals to 50,000, right? And then now we just calculated, let's say depreciation for old. We just calculated depreciation for old for the current year, where we said cost price multiply by rate multiply by time. Cost price of old multiply by rate multiply by time. Remember, we can only have a fully depreciated asset when we are using the cost price method, right? Now, let us assume that we just calculated this method. This method gives us a depreciation of 70,000. Now, what can we see? We realize that this is step number 2, where we're saying carrying value is less than depreciation, right? Our carrying value is 70. Our carrying value is 50. Our depreciation is how much? It is 70. Then we have formula number 2, where carrying value is less than depreciation. Now, what can we say? If we say carrying value minus that depreciation, what are we going to have? We are going to have 50,000 minus 70,000. What are we going to have? Negative 20,000. Now, where are we now? We are having an asset that is negative. We do not allow an asset to be negative. Hence, we are saying we need to apply what you call a 1 rand rule. How are we going to apply 1 rand rule? We said for us to apply the 1 rand rule, we're going to say, therefore, we do not allow 20,000. Why? 20,000 give us a negative figure, a negative carrying value. And an asset cannot have a negative carrying value. Then we say, okay, if we do this, let's say, okay, if we cannot accept this, we say, therefore, let's take the carrying value and subtract 1. Now, how much is our carrying value? Our carrying value, remember, it was how much? It was 50,000. Then we can take the 50,000, we subtract 1. How much are we having now? We are having 49. We're having 49,999 minus 1. Now, if we say 49,999 minus 1, what are we having now? We are having 50. Let me erase here. Sorry, I just made a blunder here. If we say 50,000 minus 1, what are we having? We are having 49,999. Then this is our depreciation for the year. What are we saying? We are saying we can only allow our depreciation to lose up until 49,999. We cannot allow it to be more than this point, so that we can have a value, of 1 rand at least, to show that that vehicle is still alive. How are we going to say that? We're going to say, if we can remember, go back here, we said carrying value minus depreciation. In this case, what are we having as carrying value? We are having a carrying value of 50,000, and the depreciation that we said we are going to allow, it is how much? We are not allowing the 20, we are allowing the 49. So we are going to say 50,000 minus the 49,999. Then what are we having here? We have 1. Right? Now, for me, so that I can explain this better, let's just try and skip everything here and go back to activity number 2. Let's go to activity number 2. Right. On activity number 2, but they are saying to us, depreciation for vehicles are calculated at 20% per annum on cost, right? Now, we need to calculate them on cost. I'm saying when we are using a cost price method, there is a possibility of fully depreciated. We need to be aware of that, right? Now, I just said to you, for us to do that, we need to identify, for us to calculate depreciation, we first must identify whether we have an asset that is new, whether we have an asset that is sold, whether we have an asset that is unsold, that is old or remaining, right? Now, let's go and check. Now, we have an asset, the cost price here. This is the cost price of an asset at the beginning of the year, right? Now, this is unsold. That is 350. We have the new, right? Ticked. Then we go to the next one. Let us go to the movements. Movements will give us a new one and the sold one. If we go to the movements, additions means new. Sold means disposals means sold. Right? Now, let's move. Let's check. Now, we have an addition. Addition is how much? That is new. It is how much? It is 422,550. Right? And then we go back. Let's go and check. Do we have the sold? Sold is how much? It is 0. Then we are going to calculate depreciation for what? For 2 things, new and old. Right? Now, let's go and straightforward and calculate for new. Let's find depreciation for new. Then we are going to say cost price of new multiply by rate, multiply by time. Remember, we said this is the cost price method. Then we must use the cost price. How much is the cost price of new? It's 422,550. Then we multiply by the rate. How much is the rate? They said their rate is how much? 20%. Then we are going to say 20 over 100. Here is their rate. They said the rate, it is how much? 20%. Then it's 20 over 100. Then we multiply by time frame. The time frame is over 12, right? And then now we need to identify when did we buy this new vehicle, right? They are saying the company has 2 vehicles on 29 of February 2020. When is 29 February 2020? That is February. It started in March. In March 2020. It ends, this started in March 2019. It ends in March 2020, February 2020. Here it's February 2020. That is at the end of the year. Now they are saying at the end of the year, they had two vehicles, which is old and new, right? Now we move. When did we buy this one? One of these vehicle was purchased on the 1st of September. Now the other one, the new one was purchased on the 1st of September. Now we want the time. March, April, May, June, July, August, September, October, November, December, January. When did we buy this vehicle? On the 1st of September. Then it means from the 1st of September, we had that vehicle and we drove that vehicle. So it must lose value on our business from the 1st. Then that means September, it is included. We said we are going to count from September going outside. Now we count from here going outside because of it is new, right? How many months do we have it? 1, 2, 3, 4, 5, 6. Then we're going to have 6 over 12. Then we are going to have 42,255, right? Then we are saying we are going to have 42,000. We are going to have 42,255. Now, that is the depreciation for what? For the new one. Now, let's check for the sold for old one now, because we said we don't have the sold. Let's check for the other one. Let's go and check for old. Then we said for old, we are also going to say cost price of old multiply by rate multiply by time. How much is the cost price? The cost price, it is 350,000. What is the rate now? The rate, it is still 20 over 100. Remember, I said because of it is old, we did not sell them. Then we're going to have 12 over 12. Then we're going to say multiply by 12 over 12. How much are we getting here? Then we are getting 70,000, right? Now we have 70,000 for old one. Now we take, this is our depreciation for the current year. Let's take this depreciation, that's 70,000, and compare it to the carrying value of that vehicle for that specific vehicle. You see the carrying value of the specific vehicle. This one, the old one. Remember, here it is the old one, the one that we just calculated. Here is the old one, right? Its cost price was 350. It lost the value of 315 over the years. Now this year, at the beginning of the year, it was worth how much? 35,000. Right, now we applied the cost price method to find the depreciation for the current year. Where we said the cost price method, we're going to say cost price multiplied by 20 over 100 multiplied by 12 over 12, right? Then depreciation for that specific vehicle for the current year, it is how much? It is 70,000. Right, how much is its carrying value? How much is the carrying value at that point? Its carrying value, it was 35,000 at the beginning of the year. And it has lost depreciation for the current year by how much? By 70,000. Then we have the carrying value at 35,000, the depreciation at 70,000. Let me go back. Let's go back to that specific vehicle. Right. Now, we are trying to say we want the depreciation for the sold. We want depreciation for the sold. How are we going to get the depreciation for the sold? Let's go back to our first slide where we had the formulas. Let's go back to the formulas. We said when we are applying a cost price method, for the old ones, this is what you are going to say, right? We said we're going to say cost price of old minus sold multiplied by rate multiplied by time. On the one that you are busy with, remember, we don't have the sold. Our sold is 0, right? Then now let's go back to it. It says to us we must find the cost price of the sold. The formula says depreciation for old, man. Depreciation for old says, let me try and write a little bit better. Depreciation for old says we must first say cost price of old multiply by rate multiply by time. Then now let us go and check. How the depreciation for old, it must be found by cost price multiplied by rate multiplied by time. How much is the cost price? Now here are the old vehicles. Here it is what we had at the beginning of the year. We had 350, 315, and 35. That is the old ones. Now the cost price at this point, it is how much? How much is the cost price? The cost here. How much is the cost here? 350,000 is the cost, right? Then we multiply by the rate. Here is the rate for vehicles. For vehicles, and we are dealing with vehicles. How much is the rate there? 20 over 100. Let's go back to this information here. Bulletin number 2. It says the company has 2 vehicles on 29 of February, right? It means at the end here, we are having two vehicles at the end of the year. At the end here, we are having 2 vehicles. We are having 2 vehicles at the end of the year. Let me try right here. We are having 2 vehicles at the end of the year. The other one was purchased in September. The other one was purchased here. One was purchased, it means we had 1 at the beginning. So the cost price for the one at the beginning, it was 350,000. The one that we are just purchasing now, it is 422,550. So now at the end, this is what we are having. So we are looking for depreciation for this one, right? Then now we say we multiply by rate. Now they are saying at the end of the year we had 2. 1 plus 2. It means there are 2 here, right? Now it means this one lasted the entire year. Then it is 12 over 12. Then we found the depreciation at how much? At 70,000. Right. Now we have a depreciation of 70,000. This is our depreciation for what? For the old ones. Which ones are the old? These ones that were worth 350. Now we are having a depreciation of 70,000. Now we are saying, let's compare this 70,000 to what? To carrying value. Compare this 70,000 to the carrying value. Now we have 70 and our carrying value is equals to how much? Of that vehicle specifically at the beginning, it has a carrying value of how much? The depreciation is 70. The carrying value is how much? Is 35. And then now let's check. Let's go back to slide number. Let me go back to this slide when we're explaining the cost. Now, here is the slide. Right. Now we said we can have an asset that is fully depreciated. How are we going to see that? We said this is step number 1, the way we see it, and this is number 2. Where are we now? We realize that the carrying value is less than what? The depreciation. Are you aware? The carrying value is 35,000. The depreciation is how much? It is 70. Then what does that mean? It means this asset, it is fully depreciated. How is that? We are going to say carrying value minus depreciation. It must not give us a negative figure. It must not, right? Now, in this case, we are saying carrying value is 35,000 minus 70,000. It gives us what now? 35 minus 70. How much is that? It is negative 35,000. And then what did we say? We cannot allow it to have a negative figure. We cannot allow it to have a negative figure. Then we do not allow this depreciation. Hence we said now, because we do not allow it to have a negative figure, hence we said we are going to take this depreciation that we just got. We are going to say this depreciation that you got here and say, okay, we have found a depreciation of 70,000. That is more than the carrying value. Therefore, we are going to say, therefore, we do not allow this because it is going to give us a negative figure. Then we say carrying value minus 1. How much is our carrying value? Our carrying value, it is 35,000. We subtract 1. Then what are we having now? 3, 4, 999. Then we are saying this is the depreciation that we allow the asset to have for this year so that it cannot reach negative. At least let it be 1 rate. If we can say carrying value minus depreciation, what are we going to have? Carrying value, it is how much, Kanene? 35,000 minus depreciation. How much did we allow the depreciation to? It was how much?
34,999.
34,999. Now, how much are we having here? 35,000 minus 34,999. How much are we having?
1.
Then that's what we said. We have applied what you call 1 rand rule. We allow it to lose up until 34 so that it can be left with 1 rand. Right. We will get there. Then we have the bank, debtors control, creditors control, and then now we can sell off this asset. We were selling the asset. We can either sell that asset by loss. We can either sell that asset by profit. Now, what do we mean? If we realize on this side, it is bigger than these two things. It means we sold at a what? At a loss. Then it means this side, this is 90,000 and this is 30,000 and this is 40,000. We sold by 40,000. Then we can say which side is bigger? The 90,000 it is bigger. Now if the 90,000 it is bigger, if the 90,000 it is bigger, what does that mean? The 90,000 is bigger. It means we did not have any profit. We sold at a what? At a loss. Then we are going to say 90,000, it is the bigger side. Then we're going to have 90,000. We take the 90,000 to the other side, 90,000. 90,000 minus 40 minus 30. We are going to get how much? 20,000. That is the loss we have made on that asset. This will be recorded in the income statement under expenses as a loss on sale of an asset. And then now if we sold by profit, then that means this side will be bigger than this other side, right? In this case, let us assume that now we don't have 40 here. We sold that asset by at least let me say 70,000. We sold that asset by 80,000. Let us assume we sold that asset by 80,000. What are we having now? We are having 30,000 plus 80. We are having 30,000 plus 80, that is 110,000. 110,000, we take this 110 to the other side. 110,000. 110 minus 90 will give us how much? 20,000. That 20,000 is now what? A profit. It will be recorded in the income statement as what? As an income. As an income. Right. Now, that's what we said when we are looking for profit or loss on sale of an asset. Or we can compare the carrying value. We compare the carrying value at the end. How are we going to get the carrying value at the end? Remember, I've already done it. We said cost price at the beginning minus accumulated depreciation minus depreciation for the current year. Then this one gives us what? The carrying value. We compare the carrying value against money received, that is bank, if we sold by cash, right? Which is here at this point, if we sold by cash. Or we can sell by credit, that is debtors control if we sold on credit. Or we can sell by trade in, that it means we will owe those people. We sold by credit, that will be creditors control. Right. Now in this case, what are we saying? If we find that the carrying value, it is more than this, bank, debtors control, creditors control. If the carrying value is more than the bank, debtors control, and this what do you call this? The creditors control. Now, what does that mean? It says the carrying value is more than what we have received. Then it means in that case we sold at a loss. If what we have received, that is bank, debtors control, or creditors control, it is less than the carrying value, then it means we sold at it is more than, I meant to say it is more than the carrying value. If it happens that it is more than the carrying value, it means we sold at a profit. We sold at a profit. That is a profit on sale of an asset. Now, the carrying value at the end. The carrying value at the end, how are we going to get the carrying value at the end? We are saying this is the formula to find the carrying value at the end. We are going to say carrying value at the beginning plus additions minus disposals at a carrying value minus depreciation for the current year will give us the carrying value at the end. Now we are looking for this carrying value. Right. Let me start and say, what is the cost price? Let me write in full. Now we are saying, what is the cost price? Now the cost price, it is the original original price in which we purchased the asset with. In which we purchase the asset with. In actual sense, if we go to VW and we buy a car by 200,000, that is the what? That is the cost price, the original price, right? And then now, number two, we are saying number two, we have what you call depreciation. What is depreciation now? It is the loss of value. It is a loss of value in there. It is the loss of value. The depreciation, it is the loss of value in the current year. That's what we mean when we talk about the depreciation. What is accumulated now? Accumulated depreciation. Now, what is accumulated depreciation now? We are saying now is what? Loss of value over the years. It is the loss of value over the years. What does that mean? It means depreciation are combined. Depreciation are combined. If we say depreciation for year 1 plus depreciation for year 2, then what do we have? We have what you call accumulated depreciation. Yes, then we're going to have what you call the carrying value. Now, this one means the value of, this one means the value of the asset, the value of the asset at a point in time. What do I mean when I say at a point in time? Where we are at that point, what is the value of that vehicle? Do you get what I'm trying to say? What is the value of that vehicle? What I'm trying to say is, let us assume I buy a vehicle on the 1st of January. I'm driving it. On the 2nd of January, what is the value of that car? I've driven it on the 1st. Now on the 2nd day, it has lost value. How much does it worth at that point? Do you get what I'm trying to say? How much does it worth on the 2nd of January, not on the 1st? That is what we mean about the carrying value, the value that is left with. Right. And then now we can move the carrying value part. Let me just erase and write it better. Right. Now the carrying value part, what are we saying? We are saying it is the value of an asset. It is the value of an asset at a specific, at a specific point in time, at a certain date. Remember, we had the cost minus accumulated. What are we saying? We are saying the cost price minus the loss of value. Then that will give us what you call, the carrying value. The value of an asset at a certain point in time, or at a specific point in time. How much it is worth at that point. Now let us go to activities so that we can actually see what are we having. Now we'll come back to activity number 1. Let me just go to activity number 2 and start everything over, because in this point I was actually explaining number B, that is the depreciation. Let me try and erase everything here so that we can start afresh to see what we are talking about. Right. Now let us move along and check. Now, at this point, we are saying they want the carrying value at the beginning. Now, when we're talking about the land and building, remember that the land and building does, does not lose value. Right? The land and building does not lose value. It means it does not depreciate. What do we mean? The cost price is similar to carrying value because of it does not lose value. If the land and building does not lose value, the cost price is similar to what? To carrying value. Then, now we can use either carrying value calculation or the cost price calculation. Let's go back and check that formula. Let's go. I said to you, remember to cram your formulas. Right. Let's go back to the formulas. Now, then we can check the formula number we said here is carrying value at the beginning. We want the carrying value at the beginning, but using the end information. Here it was the cost price method. Here it's our cost price method. We can actually say cost price at the beginning plus additions minus disposals at the cost price is equals to cost price at the end. Or we can use this one where we said we talked about the carrying value at the end. Where we talked about the carrying value at the end, where we said carrying value at the beginning plus additions minus disposals at carrying value minus depreciation at the end. Why is that so? Because land and building does not lose value. Cost price method and the carrying value method can work. Now let's go and check. What am I saying? Let's check. We are saying we can either say cost price at the beginning plus additions minus disposals at a cost price is equals to cost price at the end. Or we can say carrying value at the beginning plus additions minus disposals at a carrying value minus depreciation is equals to cost price carrying value at the end. We can either use number 1 or number 2. We want A for land and building. It means whether you use cost price, whether you use carrying value, because it does not lose value. Land and building does not lose value. Right, let's go and check. What are we looking for here? We want the carrying value at the beginning. I said carrying value and the cost price are the same when we're talking about the land and building, because they do not lose value. Remember, we get to carrying value when we have subtracted the loss of value. We said for us to get to the carrying value, we said carrying value is equals to cost price minus accumulated. Now, what is happening? Land and building does not have this. It does not lose value. Right? So we can either use formula number 1 or formula number 2. What are we looking for? We are looking for cost price or carrying value at the beginning. This is what we are looking for. Right? And at this point, this is what we are looking for. Now, what can we do? What can we do at this point? We can say, let me just try and erase here. This is what we are looking for. We can say what we don't know plus the additions. Do we have the additions on the land and building? We do have the additions. At how much? Now we can say 325,255,000. Now what are we looking for? We are looking for this. Then we can make this a subject of the formula. We can make this a subject of the formula. We are looking for A. This is our A. We don't have the A, but we have A plus something minus something. It's equals to 2550. We want the A, not A plus or not A minus. You get what I'm trying to say? Now let's turn our A into a subject of the formula. Then we can say A, we take all the numbers on the other side. All these numbers, when they cross the bridge, they realize they find something on that side. Then we have 2550000. What are we going to have that side? We're going to have Messi is leaving PSG. He's going to America to play in America. Now he has to change the jersey. The jersey of Messi, it was blue, which is a positive sign. Now when he goes to that other side, he's going to have what? A change of jersey, a negative sign. Then we have 3250000. Then our A is equals to how much? 222. We have 225,000. Let's go and attempt B. Let's go and attempt B. Yeah, B it is depreciation. In terms of the depreciation, kina part ya depreciation. Barry, depreciation on vehicles, and we are looking for depreciation on what? On vehicles. But depreciation on vehicles at 20% on cost. Then it means we are going to use what we call a cost price method. Re tlo sebedisa cost price method to calculate what? Depreciation. Now let's go back and check what was our cost price method. Here is our cost price method. We said every time we are looking for depreciation, we have to be on the lookout for this. New, sold, and old or remaining equipment. Now, in this case, we have, are we having the new? Are we having the sold? Are we having the remaining? Let's go and identify. What are we having? Let's go and identify what are we having. And remember the formulas when we get to that point. Remember these formulas that we are going to use on the cost price method. Let's go and check. Here is B. Ke batla ho shebana le e new, ke lo shebana le e sold, ke lo shebana le e jwang, le e unsold, which is old or remaining. Ke lo shebana le tsona. That is depreciation. I get it. Ke batla depreciation. Every time ba batla depreciation, ke lo ke ipehele tsona tje. Ke lo di batla. I get it. Now ke ka nna ke re ha ke qeta ho di ngola new, sold and unsold, be di ipehela di formula tsa ka. Ke lo ke di behe clear. For cost price method, formula ya cost price ba itseng ke tlo cost price multiply by rate multiply by time. I get it. And the time ke tlo ba like ya kantle over 12. Sorry. Right? Then we are going to count going outside. Every time they are saying we must calculate the cost price method, you must always remember that you are going to have new, sold, and unsold, which is the remaining, right? Now I've put them here. I've said cost price multiply by rate multiply by time, and we count going all outside. Now, then I go. I did not look at the question. The question says I must do what? Calculate depreciation using what? Using the cost. I don't care what I'm having. I'm just writing my formulas down for new, sold, and unsold. Right. Now, in this point, I'm saying I did not look what they are looking for. I looked that they are looking for B, that is depreciation. The first thing that I must identify, I'm calculating a depreciation using which method? In this case, they are saying we must use which method? We must use the cost price method. Then I'm writing the formula for cost price in calculating depreciation. I said I must always be on the lookout for three things: new, sold, and unsold. Now I'm putting down my formulas. I'm saying cost price of new, cost price of sold. Okay, cost price of sold minus accumulated of sold at the beginning, right? Then let me put this in bracket. Then I multiply by rate, I multiply by time. Where am I counting? I'm going to count going inside over 12. For an unsold now, we are using a cost price. Sorry, can I go back to the sold one? I nearly missed the formula. Now we set cost price of sold multiply by rate multiply by time. Remember, we are using a cost price method. I used a formula for carrying value method. Right, now let us move along. And then we're going to talk about the cost price of unsold. Then I say cost price of old minus the cost price of sold. Then I multiply by rate, I multiply by time. My time is 12 over 12. That was the case. I said I'm looking for depreciation using the cost. Then I go and check. I said every time there is a depreciation, I must calculate for new, sold, and unsold. I must check which ones do I have. Then let's go and check. Do I have a new vehicle? And I said a new vehicles, it is additions. Do I have additions? Then I tick. I have this ones. I have additions. Then let's go and check. Do I have the sold? Remember, the sold, I said it is the disposal. Do I have the sold? I won't be calculating for this one. This one is out of the equation. Then it means if I have the old, do I have the old ones that are lasted from the beginning until the end? Then here is at the end. Here is the end. Here is the end. Do I have the cost at the end that lasted at the beginning until at the end? I have new and old, right? Let's go and check now. Let us go and check the cost price, the cost for new. How much is the cost for new? For addition. How much is the cost for addition? Then we have the cost for additions at this point. That is 422,550. Then we are looking for the rate. The rate is given always. What is the rate?
20 over 100.
Then we say 20 over 100. We multiply by the time. Remember, this one is new. If I'm buying my VW in June, then I'm going to have that VW from June up until the end of the year, right? Then in this case, we are saying For a new one, we want to count from now until the end. Now let us go and identify the time frame. Our time ends in February 2020. It starts when? In March 2019. Remember, each and every year, our year ends in December on the 31st. Right? March, April, May, June, July, August, September, October, November. Now, we must go and look for a vehicle that has been bought, the additional part. When did we buy that vehicle? So that we can count here over 12. When did we buy that vehicle? Now, let's go and check. They are saying to us, the company had 2 vehicles on the 29th of February 2020. When is 2020 February? Here it's February 2020. The company is having 2 vehicles here. Now, these vehicles at the end, they cost how much? 772,550, right? That's at the end. Now we move. Here we said it's at the beginning. This is during the year. Right. Now let's move. They had 2 vehicles at the end. One of these vehicles was purchased on the 1st of September. One of these 2 was purchased here. Then how many did we have at the beginning? We had 1. Right? Now what are we saying? We are saying we are looking for addition. Addition is this one that has been purchased on the 1st of September. Now we are going to count from where? From September going outside, because we're going to drive this vehicle from the 1st of September. Now it has to lose value on us from the 1st of September. Now we're going to count from the 1st of September going outside. Then it says 1, 2, 3, 4, 5, 6. Then that vehicle will last for 6 months that year. Then what are we having as our answer here? 42255, right? Now this is the depreciation now. This is the depreciation for new, right? And then now we just said we do not have the sold. Then it means our depreciation here, it is how much? It is 0. Or we don't have the sold. Okay? Then we move. Let's go and check the remaining ones, the unsold. We don't have the sold one. We just said we don't have the sold one. The sold one is 0. How much is the cost price of the old that we started with? 1 vehicle that we had at the beginning of the year. What is the cost price of that one that we had at the beginning of the year? What is the cost? Then we have 35000. That is old at the beginning of the year. The ones that we started with, the 1 vehicle that we started with before we purchased the second one. Right? Before we purchased the second one, we had a cost price of 350,000, and then we purchased another one that was worth how much? That was worth 422,550. Hence, we have this one at the end, 772,550. These are the old ones. These are the new ones. So at the end, we have these ones. We had 1 vehicle at the beginning of the year, the one that was worth 350. Remember, on this information, they said the company has 2 vehicles. Here are 2 vehicles at the end of the year, right? Now, they are saying 1 was purchased on the 1st of September. The one was purchased here in September. Then how many did we have at the beginning? So we are saying we started with 2. We purchased 1 here. We want to go back. How many did we have when we started the year? I started with the 1 vehicle, just bought a new vehicle. At the end, I have 2. Now, at the end, there was an additional one that I've purchased in September, which is 422,550. Now, at the end, in combination, the 2 of them, they are how much? 772,550. So this one is the first vehicle, the one that I had here. Then I multiply by rate. I'm looking for rate. How much is the rate?
20 over 100.
20 over 100. Now, then it means I'm going to have 12 over 12. So that vehicle, I loved it more than anything. I did not want to try and sell it or do anything. I had that vehicle for the entire year. Then it means we are going to have it for 12 months over a 12-month period. Then how much are we going to get here? Then we are going to have 70,000. This 70,000, it is the depreciation for the year. Now we said, because we are talking about the old, we said be careful. We said be careful of a fully depreciated asset because I loved this vehicle. I loved this vehicle. So now I have to be aware of now. Did it lose value entirely or what is happening? Now, then they say we must be careful of fully depreciated asset. Now, why we saying so? We said now, this vehicle cannot have a negative balance. Now, the depreciation is 70. Let's compare the depreciation. We said we must compare the 70 to the cost price. We must compare to the, not cost price, we must compare to the carrying value. Right? Now, when we compare the 70 to the carrying value, what are we having? We are comparing 70,000 to the carrying value. Now the carrying value, it is how much? We are comparing the 70,000. Let's compare the 70,000 to the carrying value. 70,000 compare to carrying value, and we just said the carrying value is how much? 35,000. Here is the carrying value of that old car of mine. It is 35,000. Now we are saying, if we can say 70,000 minus 35,000, we are going to have a negative figure, right? And then we do not allow this thing. We are going to have a negative 35,000, and then we do not allow if it has a negative figure. We are going to allow to at least be left with 1 rand. Hence, we said we are going to use a method where we say, if this happens, we are going to apply what we call 1 rand rule. Now, let us apply the 1 rand rule after comparing the carrying value. After comparing the carrying value, now we have compared the carrying value. We have compared the carrying value to the asset. Now we realize the depreciation is more than the carrying value. Now what do we say? We said we are going to say, therefore, we do not allow this. We don't want this. We are going to say carrying value minus 1. What is our carrying value? Our carrying value was 35,000. We subtract 1. We have 1 rand rule now. That is 34,999. Then we have applied 1 rand rule. Then we allow this vehicle to lose value up until 34,999. It cannot be more than 34,999. So that you can say it has left with 1 rand rule. Then we have calculated depreciation for old and new. And this is all that we had. And we had 0 for sold. Now, then it means let us combine them to find B. Our B is equals to how much? Depreciation for number 1. That is new. How much is the depreciation for number 1? 42255. That was the depreciation, right? And then now for sold, we just found that the sold it is 0 because we did not sell anything. Plus the depreciation, we said it is 70, but we do not allow 70. We want what? 34,999. Then we are going to say plus 34,999. Then we are going to have how much? Then we are going to have 77,254. That is the depreciation. That is letter B. That is letter B. Then now, let us go and check for now letter C. Let's go back and try letter C. Let us go and try letter C and see what is letter C. What is letter C? Carrying value when? At the end of the year, right? Note to this. Let's check. Let's go back and check. This one was carrying value at the beginning was cost price minus accumulated. That was at the beginning, right? Let's go and check at the end. Let's go and check at the end. Look at this one. Carrying value at the end. It is carrying value. Here it is. On this page. Carrying value at the beginning plus additions minus disposals. We are looking for carrying value at the end. Here is the formula that I said you must grab. Carrying value at the beginning plus depreciation additions minus disposal asset carrying value minus depreciation. Now let's take the formula to that section and see whether it works for us. Right, we said we are looking for C. And C, what is C? C, it is carrying value at the end. We said, how do we find the carrying value at the end? We said it's carrying value at the beginning, right? Plus additions minus depreciation that we just calculated minus disposals at carrying value. I just misplaced these two. I put depreciation before disposal, but it's still fine. They are both subtracted. It's fine. Right. Let us move along. What is the carrying value at the beginning of the year? Now, the carrying value at the beginning, it is 35,000. The addition, how much is the addition now during the year? It is 422,550. Now, how much is the depreciation? Minus 77,254. Again, 77. It was, we calculated 77,254. Right. Now, how much is the disposal minus the disposal? How much is the disposal as a carrying value? We have 0 as our disposal. Then we can get what you call carrying value at the end. Now, for us to get the carrying value at the end, we said we are going to take the carrying value at the beginning from here. He said, here is our carrying value at the beginning. And then we said we are going to look for additions. Here are our additions. And then we said we are going to look for depreciation. Our depreciation, we have calculated it on the previous slide. Here is the calculation of our depreciation from the previous slide because of we just need to put it here at our B. We said B, it is how much? It is 77,254 to make things easier for us. And then we move. Now, we are going to calculate our disposals. Our disposals was at 0, and then hence you got a carrying value of 380,29296. And then now we still need to move forward. Now let's change this one and put in our carrying value. How much is our carrying value? We just said our carrying value at the end. Our carrying value at the end, it is, here is our carrying value at the end. It is 380,296. Right. Let us move along. Let's go and check let's check for information on equipment because they want letter D on equipment. Now let's go and check information on letter D. Let's move to letter D. Right. What is it that you are looking for on letter D? What is it that you want? What is letter D? Disposals, right? Now, disposals here on the fixed asset note are disposals at a carrying value, right? Not at a cost. We are looking for carrying value of the disposed because we want to understand what is the carrying value at the end. Then it means we are dealing with carrying values alone, right? Now let's go and check because we are going to add carrying value here and here so that we can get this one. So we are looking for carrying value at this point, right? Now, what was our formula for disposals at carrying value? Let's go back and check our formula. Let's go and check our formula for disposals at carrying value. Let us go back. Here is our formula. Right? We said we can either say cost price of sold minus accumulated of sold at the beginning of the year minus depreciation. Now let's go and put it here and see whether it works. Let's come and put it here to check whether it works or I'm just lying. Right. We are saying for us to find the disposals at carrying value, our formula is cost price of sold minus accumulated of sold at the beginning minus depreciation of sold. Right? Now let's go and check. Let's go and check. Do we have the cost price of the sold? Let's go to information letter from a bulletin number 3 where they are talking about the asset that has been sold. Remember, I said we are looking for disposals of the sold where we have sold an asset. Let's go and check from an extract on the information regarding the sold vehicle. Do we have the cost price there? Now, this is what we are talking about, the cost of the asset that has been sold, which is 120,000. Now we have 120,000 as the cost price of the sold, right? And then now we are looking for accumulated depreciation of the sold when at the beginning of the year. Which year? The one that we are selling this vehicle this year. We are looking for it for this year at the beginning year, right? Then now they are saying to us, we have bought this asset when the date of purchase of this asset was 1 March 2016. When are we selling it? We are selling it when? We are selling it date sold 31 December 2018. Now we want the depreciation at that point. We bought this vehicle. Let's check. Let me draw out a time frame from the date of purchase. They are saying we have bought this vehicle on the 1st of March. Here is March 2016. It will end in February 2017, right? And then we move. We go to another year, which is February. It started in March. It started in 2017. It ended in 2018, right? And then this is the year that we are selling this equipment. This equipment is started when the year started in March 2018. It was sold in February 2019. It ended in February 2019, right? Now let us move and check. It was sold, date sold is 31st of December 2018. Now let's move. Now, when did we purchase this vehicle? 1st of March 2016. Here is 1st of March 2016. It ends in February 2017. That is the first year of having that vehicle. The second year, we have purchased this vehicle. The second year, it is 2017. That ends in 2018. Right? The other year starts in March 2018. It ends in March 2019. Right. Now let us move and check. Let us move and check. Now we move. Now this vehicle was purchased here. Let us identify the depreciation for year one. They are using which method? Let's identify. Depreciation rate is 10% per annum on diminishing balance method. Then they are using a carrying value method that is diminishing. They are using a diminishing balance method, right? On the diminishing balance method, and we are talking about the sold one, we said the formula for sold one, if I can go back for you so that you can remember the formula. Okay, let's leave it. Let's just write it. We said we are going to talk about the depreciation for sold using the carrying value method. Right, let's go back to that depreciation. Here is it. Now they are saying we must use a diminishing balance method to calculate what? The sold one. They only wanted the sold, right? Then we must use this formula where we said cost price of the sold minus accumulated depreciation multiplied by rate multiplied by time frame, right? Now let's go back and see what do we have. Let's go and see what do we have. Right. This is where we were. Now we are saying, for the first time, I wanted to identify this 12,000. Where is it from? Hence, I said we bought it here. This is the first year of having that vehicle, the second year, the third year, right? Now, let's move. Now, we want the depreciation of the sold. We are saying, how are we going to find the depreciation of that one that is sold on the first year? We said the formula is cost price. Let me try and erase so that we can see what happened here. Here it is the year that we are talking about. This is where we are. Now we said we are going to calculate depreciation of sold multiplied by rate multiplied by time. Let me just write it here. Cost. Now we said we are applying we want to identify depreciation here for year one. That is, we are going to say we want depreciation of the sold. Then we said depreciation for sold using diminishing balance method. Here is the formula. We're going to say depreciation. That is cost price of sold minus accumulated depreciation multiplied by rate multiplied by time. Now let us move and check. What is the cost price of the sold? Now we're going to check on the extract from the fixed asset register, the register of the assets. Now let's go to the register of the assets. Now we found the cost price, it is 120,000. Then I'm going to say 120,000 minus accumulated. Remember, this is the year that I had it. This is the first year. I've just bought it. It is new to me. I love this car of mine, this equipment of mine, this computer of mine. I love it. It's new. It has not yet lost value on any way. Hence, we are going to say our accumulated depreciation it is 0. It is new to me. Whether what happened to it on the previous owners, I don't care. To me, it is new. Hence, it has no loss of value. Then I'm going to multiply by rate. What is my rate here? My rate, it is 10 over 100, my time frame, it will be, I bought it here, then it means it's going to last me for the entire year. That is 12 over 12. Then now, what's the depreciation on the first year? Let's go and check. 120, it is 12,000. This is the first year. Here is the 12,000 for first year of the loss of value. Do you see it? Then this vehicle is left with a carrying value of how much? Of 100. The book value means carrying value. Then if you say cost price minus depreciation or accumulated, it will give us what? 108,000. Right. Now let's go to the second year. Let's try and move to the second year. Let me just try and find a cleaner page. Let us try and move to the second year. Sorry. Now, I will write here. Let's move to the second year. On the second year, we still have this vehicle. This vehicle, its cost price, it is still 120. Remember, the cost price does not change. If you go to Sports Scene today and buy a jean worth of 600 rands, of a red bag jean that is worth of 600, how much will you, how much is it? How much did you buy it in 2050? If I ask you, how much did you buy that jean? I'm saying, today, you are buying a jean worth of 600, right? And then someone in 2020 asks you, how much did you buy that jean with? How much are you going to say? You will tell that person, I bought this jean 600, even though it will be 10 years, 20 years ago. But that jean was actually, you bought it actually by how much? By 600. So that's what we mean by cost price. The cost price remains unchanged. It will remain unchanged because of that's how much I bought that computer of mine, right? And then now we are saying minus accumulated depreciation. Note this vehicle on year one, it was new to me. It was not used. This equipment was new to me. So it did not lose any value. So it was zero at that point. Hence we had 0 here. But on the second year, because here on year one, it had lost about 12,000 on year one. That's how much the loss it had. The loss of value, it was how much? 12,000. Now, if it is the loss of value is 12,000, then it means we are having a depreciation this year. Unlike on the first year. On the second year, we are having a depreciation from the first year. Unlike here where we had 0 because it was new to us. It was not used. Hence, we had 0. It was not used by us. Do you get what I'm trying to say? It was for the first time it loses value. It lost by how much? By 12,000. Then we are going to subtract this 12,000. Then we have what you call the carrying value. We are going to multiply by rate. Our rate, it was how much? 10 over 100. Remember, this year we have not sold this equipment. It lasted us the entire year. Hence, we are going to have again 12 over 12. Then we are saying, what is our book value? 120 minus 12,000, it is how much? 108,000. 108,000 multiplied by 10 over 100 multiplied by 12 over 12 will give us the second year depreciation. This is the first year. This is the second year. How much is it? Then it will give us 10,800. Let's look at it. Let's check our year for 2018. Here is 2018. It starts 2018 March until 2019 February. So here it is March, April, May, June, July, August, September, October, November, December, January. Now, this vehicle, this equipment was sold here. It was sold on the 31st. Then it means during the December, we drove that car. So we had this car up until 31st of December. So we said we are going to count going inside, right? We said for sold, we are going to count going inside. Now we sold this. We sold it here. It lasted us for how many months? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That is 10 months, right? Now let's calculate that. We are going to say depreciation of sold. It is how much? We said cost price, it will remain the same. 120,000 minus accumulated. Now, what is accumulated at the beginning? We are having this. We are having this. Then it means at the beginning of the year, we are having 12,000 plus 10,800. We are having 12,000 plus 10,800. How much is that? We have 22,800. Remember, we said what is accumulated? Accumulated is it is the combination of depreciation over the years. Right? Now we are having an accumulated depreciation of 22,800. We want the depreciation minus 22,000 minus 22,000 minus 22,800. We multiply by rate. How much is our rate? 10 over 100. You just said how many months did it last us? You said it will be 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. You said it will be 10 months. Now, what is the depreciation for the current year? The depreciation for the current year, it is 8,100. Now, what we have now, we are having the cost price, we are having accumulated at the beginning, we are having the depreciation for the current year. What was our formula looking for? It was looking for cost price of the sold. It was looking for accumulated at the beginning. It was looking for what? For depreciation of the sold. Now we have all of them. We have the cost price of the sold. How much is it? It is 120, right? Here is the cost price of the sold vehicle, right? And then now we just calculated our accumulated from year 1 to, then we said year 2, it is how much? 10,800. That is the depreciation, right? Now we move and say, okay, at the beginning of the year, here it was our accumulated depreciation. That was how much? 22,800 minus the depreciation. Where is our depreciation for the current year? Here is our depreciation for this year. For this year, the depreciation is how much? It's 8,100 because it lasted us how many months? 10. Then we are going to have minus 8,100, and then we close off this one. What is the answer now? Then we're going to have 89,100. The 89,100, it will be our carrying value here. We're going to have 89,100. That is the carrying value of the asset that has been disposed. And then now, let us move. Let's go and check for E now. For E, I did not give you the formula. I'm looking for carrying values here at this point. Right? Now, what is the carrying value at that point? We need to identify that. For E, we are going to say, let me go back and see. For E, we are going to say carrying value of land and building plus carrying value of vehicles plus carrying value of equipment when at the end of the year. Now let's go and check for this information. What is the carrying value? What is the carrying value of land and building at the beginning? At the end, what is the carrying value of the land and building? Here is at the end, right? Here it's at the beginning, here is showing. What is the carrying value at the end? Then we're having 2,550,000. Then we add what? Carrying value of the vehicles. We calculated carrying value of the vehicles somewhere. What was the carrying value of the vehicles? That was C, letter C. Right, let's go back and calculate our letter C. Let's see what we have. Right. Now let's find letter C. Here we said, how are we going to find letter C? We are going to say carrying value at the beginning plus additions plus minus depreciation is equals to carrying value at the end. Let me just remind you of the formula where we found the carrying value at the end. We said carrying value at the end will be carrying value at the beginning. We said it will be carrying value at the beginning. Carrying value at the beginning plus additions minus depreciation minus disposal. Do you remember when I misplaced depreciation and disposal? Carrying value at the beginning. How much is the carrying value at the beginning? We said it was how much? It was 35,000. Here is our carrying value at the beginning. It was 35,000. And then we said, how much is the addition? We are going to add the addition. Here is our additions. That is 422,550. 422,550, right? Minus depreciation. We had calculated our own depreciation. We said depreciation is letter B. Here it's our depreciation. When we calculated it, we said 77,254. Then we're going to say minus 77,254. 254 minus disposals. How much was our disposals? Our disposals say it was 0. And then we said we're going to subtract 0. Then how much are we having here as our carrying value for vehicles? 282.96. Remember, forget about this. It's another page. I'm just using it. Now, let's go back and see. Here it's our E. We said you're going to add 380.96 plus carrying value of the equipment. How much is the carrying value of the equipment?
50,994. 50,994.
50,994. How much is the answer now? It is 2, 9,
8,
8, 1, yes,
2,
2,
9,
9,
0.
0. Then that will be
Yes.
letter E. Right. Now, before I close off, I'm just going to give you your activity. Let me just erase this one here. You can screenshot this page or shoot it, please. Please shoot this page. Whatever that you can do, just take this page. Go and try letter I, which is carrying value at the beginning, and find carrying value at the end, and letter number 3, that is depreciation. Just take a picture of it. Right. Now, this is your activity to go look for, to go prepare. That is fixed asset. That is activity number 3. You are going to prepare for me number 1, 2, and 3. We will see one another next time. Thank you very much for your cooperations.